Good evening, ladies and gentlemen. You're watching India Tonight on ET Now with me, Samita Karir, and my colleague Ankur Mishra. Ankur joins us from our Mumbai studios. And Ankur, tonight on the show, we put the spotlight once again on tech and IT. Well, 1 week after AI company Anthropic launched its powerful new Claude co-work tool, complete with industry-specific plugins for legal, finance, sales, and data tasks, tech stocks have remained under heavy pressure. The release has fueled investor fears that advanced AI agents could disrupt and even replace traditional software as a service or SaaS platforms.
Definitely, Sumita, and enterprise software names like Salesforce and Workday, along with data providers such as Thomson Reuters and FactSet, have seen a sharp decline, some shedding 10 to 15% or even more in the recent sessions. Overall, the software sector has lost hundreds of billions in market value amid concerns over an accelerating AI disruption wave. And this disruption wave is dangerous, as called by many analysts are divided. Is this a short-term panic or start of a deeper shift in the tech landscape? Markets will be watching closely as the debate continues. And to decode what exactly should the investors watch out for, we have eminent panel. We have Siddharth Pai, founding partner of 314, and we also have Josh Koren, founder and CIO, Musketeer Capital Partners. Welcome, gentlemen. First, I want to come to you, Josh. How should market now perceive it? All right, we have Siddharth currently, and we'll be waiting for Josh Koren as well. Siddharth, I want to understand from you, as we were discussing earlier, is this just a valuation shift which is happening? Is this correction pricing something, or you think structural changes are getting closer?
I think the markets often heavily discount in the short term and actually end up being far more optimistic in the long term. I think this is also a key indication of that. This is a repricing of all SaaS companies, all software service companies, or software product companies also. All these companies were contingent on repeated inflows and high margins to end up actually coming in. And the services companies were contingent on actually deploying a large number of software engineers, or forward deployed engineers, if you will. Now, what these AI companies have actually done as of now is to say, look, the older pricing model of pricing it on a per person basis or a per seat basis has actually gone away. A large amount of this work can now be done on a 24-hour cycle without the need for as many people. So we are actually seeing that the price to earning ratios, or the PE ratios of these companies, are actually seeing a significant halving or a great compression. Because now what was actually anticipated to being high growth, that growth is going to end up actually following. Revenues will shrink and margins are actually under pressure. So it's a large amount of repricing that's happening. Simultaneously, the capital that is being released from these tech companies is actually going towards AI native companies as of now, because they are actually commanding a premium in the market, as the market is extremely bullish and ebullient at the fact that this is actually the future of tech, of the tech industry also. So the legacy industries are getting retracted, or the capital is escaping. Capital is going towards these kind of agencies, and uncertainty is actually causing a large amount of this repricing, as we end up seeing as of today.
Right, Sid, we'll talk about the IT landscape as well, but let me ask you a follow-up question to what you've already stated. Let me ask you, will IT stop being a long-term bet then for investors?
No, I think this is a fantastic time to end up looking at quality IT stocks as well. I think one thing that's extremely certain is that even these AI companies, etc., will end up actually relying on your IT services companies for implementation. It is exceptionally hard to believe that large legacy enterprises are going to end up actually going towards this, just end up actually downloading code directly off the website, waiting on without any checks, guardrails, or anything that ends up coming in. Now, what is going to be under threat is the current pricing model, where it's on a per seat basis. It'll end up actually being move more towards a sort of hybrid model, which is a combination of the AI services play that end up actually putting in, and fewer number of people that they end up actually deploying. I think that's actually number one. The second part that's also going to come in, the market is waiting for these tech companies to end up announcing larger deals with your premier AI players. We've actually seen Accenture strike a deal with Claude as of now, so their fall hasn't been as much. That now it's waiting on TCS, on Infosys, on Wipro to end up actually striking these kind of deals to see that happening. If you look at the software services companies like your Intuit and your Freshworks and even Salesforce or the others for that matter, the AI story has to come out a lot more clearly. AI is clearly the theme of the day. How well you play it, how close it's to your narrative, how that translates to revenue is something the market is actually looking at us. So it's a pricing opportunity. Those who fail to adapt will end up dying. But those who end up adapting, it's a fantastic buying opportunity for the market also to end up looking at quality stocks at great prices.
Survival of fittest is something which you are suggesting currently. But I want to ask you from a startup point of view, with the launch of Anthropic, which has happened and it has been a global discussion point, do you think the entry barriers are collapsing as far as startups are concerned?
Oh, 100%. I think what we now see, the previous large language models end up actually going a horizontal play. So they're a jack of all trades, master of none. And the verticalized AI applications was something that was actually seeing a lot of market traction also. But now I think the big question is going to be if someone like a Gemini and OpenAI or even a Anthropic can end up actually creating a verticalized solution that makes you obsolete. The kind of risk that we end up seeing on the technology obsolescence risk is exceptionally high. Even at the early stage as of now, as you start underwriting what is supposed to be a 5 to 6 year growth trajectory, it's becoming exceptionally hard to figure out what are the niches that the big players aren't actually concentrating on as of now. And we've seen that happen in video also. The video models released by Google and by Alibaba as well. A large number of the vertical AI video companies and content companies are actually under tremendous pressure. So I think they are going to go after the bulge bracket, your consulting revenue, when it comes to medical services, when it comes to information services, coding, accounting, as well as legal. Now, the other areas like education, the other areas that end up being niche engineering, consultancy, those are areas where AI has a very, very strong role to end up actually playing. So that repricing is playing out in the early stage as well as on the listed market.
Right, Sid. Thank you very much for your comments. Do stay on because we have to welcome Josh Koren, who's the founder and CIO at Musketeer Capital Partners. Josh is also joining us on this debate and this chat tonight. Thank you very much, Josh, for taking the time out. We were just discussing with Siddharth Pai, and he essentially states that this is a good buying opportunity for for good IT companies. Would you hold the same opinion, or do you feel that deeper cuts are in store for IT players, for IT companies?
Well, thank you so much for having me on the show. First of all, I always really appreciate it. So what I would say is this. I don't think that now is the time to buy these software names that have been impacted by AI. It's just unclear where the multiple compression ultimately can go. So usually speaking, something like this new happens to the market and these stocks will take a hit. So the software companies see a new existential risk, then they get hit and the multiple compresses. Now it's been overdone in the near term, so you could see a bit of a bounce in them. But going forward, we're just not sure that this existential risk will be resolved in any kind of real way that actually leads to flow of funds really coming back to these stocks right now. I think that it will take 3 or 4 quarters now going forward for the companies in question to really prove to the market, hey, look, this risk is not real for us. We actually do have a place in the new world order, call it, with these AI bots out there. And we're not going to get disintermediated. But until then, I don't think that multiples will really come back and stay back. I think people are going to use this sector as a way to kind of lighten up capital and go for more sure things. And the companies are basically in show me mode where they need to prove to the market, hey, we have a place in the world still.
Definitely, Josh. I also want to ask you a similar kind of a question because it is the best thing when you don't know, you say you don't know. And that is the situation which is happening right now. Having said that, if someone who's looking at IT stocks and particularly the impact of that fall is happening globally, you are saying that one should wait and watch. But what should be the parameters? For instance, when you are talking about the pricing, do you think that is something to watch out for? What should investor watch now?
So I think that investors need to see that, okay, these software companies continue to maintain the earnings trajectory that they've been on. So for a lot of software companies, backlog will be a key metric, right? Or, kind of like unearned cash. So people want to see, do the backlog levels of these software companies continue to stay where they are? Can the ARR metric, so like annualized recurring revenue that some of these software companies show, does that continue to grow? Do these software companies really have fundamental impact? And I think that even those who are bearish on the software space would tell you that it's probably not an overnight thing, because a lot of these software companies, even the ones that will get disintermediated, have very high switching costs, right? Like, they're good businesses. It's hard to just get out of them. So I think that even for customers who do want to leave, it's not going to be a today thing. It's probably more of a next couple quarters thing, which is why I think the market wants to see sustainable earnings continue to come from the software space, ARR maintained, backlog levels maintained, and it's going to take about 3 or 4 quarters for software companies to get out there and really say, hey, listen, we reinvented ourselves so that Cloud AI and other bots like it are not such a risk to our workflow. Because right now it's true. Let's give you an example. You could have a legal software company, let's say, that does comparison work. So law firms will buy this software to do comparison between documents and look up precedent cases. That's became completely irrelevant the moment that Cloud AI basically came out, right? Because you could literally ask the AI bot to do that. It takes a quarter of the time and no price, and that whole use case for that single vertical software company has now since gone away. So, like I said, I just think that people want to see sustainable earnings trajectory maintained, sustainable backlog maintained, and it's also the words that these companies say. People will be watching the earnings calls, listening to the management teams, and thinking to themselves, hey, have these guys actually really prepared and reinvigorated themselves for this new world order, or are they just sitting ducks for more and more AI bots to take them out? Because the final thing that I would mention here, what other people are thinking now too, is that, hey, a day before Cloud AI came out, none of us knew about Cloud AI. So right now, what do we not know about? What is the next iteration of AI bot to come out this year? And what is that impact on software companies? And I think that that's also a scary notion. And that's why, people will want to wait some time and see what else is going to come out that could be a threat.
Right. Right. Right, Josh, very well put. In fact, as you speak, we do have a couple of IT companies. They have come up with their own agentic AI models. But what kind of efficiencies have those AI models really brought into the business of these companies? That are still under question. Let me come to you, Siddharth. While we do talk about how, the new Claude tool, as far as Anthropic AI is concerned, that it has rolled out, it has, of course, led to, sort of some correction in IT stocks. But do you largely think that AI is in a bubble? Are we in a bubble when it comes to AI?
I think I actually read a fantastic quote on that. A number of horses, when cars came up, a number of horses believe we were actually in a car bubble. I think AI is actually it's a complete paradigm shift as to how operations end up actually happening. And it is a tautology that the AIs are actually better than most entry-level talent you end up actually getting in. You can actually sweat them 24 hours a day. You don't have to end up worrying about work-life balance or anything that ends up actually coming up that way. So I think AI is actually a force multiplier depending on how firms end up actually using it as of now. But what is the uncertainty is there in the market is what extent this AI can end up actually playing a role in terms of operational efficiency. For that matter. Now, even if you look at the AI companies that are there, are they worth the valuation they're there as of now? It's actually debatable. When many of these companies list, and hopefully they do end up actually listing, then the markets will end up actually deciding the true value of these companies that we end up actually seeing. So AI is the future. I think there's actually no doubt about that. They will see significant repricing amongst everyone. And for the tech companies as well, it's not just about building up these models in-house. It's actually what sort of M&A they can end up actually doing. There are a number of AI companies that are actually available of anywhere between about $5 to $15 billion. And the one thing they all lack as of now is distribution. Legacy tech companies have fantastic distribution and great reliability from their customers also. So which are the companies that are going to end up actually busting the bank, end up actually buying some of this? It's a great opportunity for them to end up actually saying.
Right. Josh, I want to come to you when you're saying we should wait for 3 to 4 quarters. Do you think this period can be even longer? Because right now what is happening, AI innovation is actually moving faster than the monetization which market is worried of currently.
Yeah, for sure. It could be. And that kind of goes back to my last point, the fear, which is that even if you got to the point of where you could say, okay, this is not necessarily such a risk specifically in Claude AI, what are other risks, right? We don't know what else is coming out. So I think people see how fast the technology innovation is happening. They view that definitely as a risk. And to your point, it could take even longer than 3 or 4 quarters, particularly if more bots come out over the next quarter, because as more and more of this comes out, people are going to see more and more risk. I just think it's hard hard to imagine that this space really attracts much flow of funds, because when you just have this existential risk that these companies could be systemically now just in a bad place, it's really hard to justify, hey, you should go and pay some kind of premium multiple for this growth when you can get it in other places in the market that don't have this existential risk. So for example, like, instead of buying this IT services company for that multiple, you could do something like buy AMD for that multiple on FY27 numbers. And I think everyone would agree that AMD is a beneficiary of this trend, and this is a loser from the trend. So I think that like these multiples just still don't price in this risk. And there's just not really much reason for people to be here right now until these companies show the market otherwise.
Right, Josh. Let me come to you, Siddharth. Now, how should investors hedge against AI-driven disruption risk across tech portfolios?
I think it's a question of geography. In India, for that matter, most of the proxy play on tech are IT services companies. We don't have the depth of software product companies or AI companies that are listed in the market as of now. So a prudent investor would actually be looking at who the beneficiaries or the second order consequences built around AI. So you look at the companies that actually end up working in fiber. For example, you look at the companies that end up actually working in power. You look at the companies that end up actually working in infrastructure for data centers. I think these are fantastic bets for Indian investors to end up actually looking at, because as the AI boom goes, as energy consumption increases, as they require more fiber and much lower latency, these are the people who will end up actually benefiting from the supply chain that they end up actually seeing as of now. Now, if you were a global investor, for that matter, your choices are actually far wider. You have companies that like TSMC and others who are fundamental bottleneck. They do end up actually making the cutting edge nodes, and that's actually critical input in terms of the GPUs that end up actually going into any of the AI companies that end up actually coming up with that. I think that's actually number one. Number two, also for that matter, any of the companies that can end up actually cracking long-term contracts with your higher ACV, average contract value. These are the companies who will end up actually benefiting from that space as well. Energy, I think, is one of the fundamentally untapped areas, because these companies are fantastically large energy guzzlers also. And many people are now creating dedicated power plants just to end up actually catering to AI data centers and the compute energy that they end up actually needing. So these are the kind of plays that people end up actually looking at. You have companies like Koren in the US, where they've actually created new fiber optic cables that are far better than copper. You end up looking at companies in the commodity space where these sort of elements like copper, etc., end up becoming fundamental inputs. So the proxy plays and the second order plays are the best ways to end up gaming it if you can't end up actually getting into the AI companies as of now. Private market investors actually can end up getting into these deals as well. So we're seeing large amount of secondaries end up actually getting done, SPVs being created. It's genuinely a large amount of capital chasing very, very few assets.
Right. Siddharth, you did mention about the positives, and one of the positives which was there in one of the conference call notes today was Bajaj Finance, where they have mentioned that 800 AI agents will be deployed, and hence their business is getting benefited due to that. But on the similar lines, I want to understand from you the data center play. How will that work out in the scenario where AI is happening currently?
No, I think, data centers essentially end up giving you compute space. And now, as the larger AI companies end up actually buying their own chips, end up actually running it. But the smaller ones won't have the capital or the ability to end up actually managing that. Now, the data centers essentially will end up renting out their compute. Renting out a compute to a number of startups to end up doing. And as every company ends up actually adopting more AI agents, they end up actually integrating this into their workflow, their computational needs will end up actually increasing. Not all of them want to end up spending the capex to do it. So to convert that capex to opex, these data center companies will end up having a fantastically long run to end up doing it. And it's fundamental infrastructure that's a critical input to almost every computation that ends up actually being carried out. And India is also now given that sort of tax holiday when it comes to data centers also, showing that the amount of the need for companies to end up actually localizing data and localizing compute is actually key. So we are actually seeing that as a very, very interesting space that is not yet fully tapped as of now, not yet fully understood. And if you can end up finding good companies who can benefit, it's a fantastic buying opportunity before the market realizes.
Siddharth, thank you very much on that note for taking the time out and speaking to us here on ET Now. The opportunities are galore, not just in the AI space, but related industries and related companies like you spoke about. And thanks again very much for taking the time out and helping us understand this AI opportunity and the kind of disruption that we're seeing in the IT space.